Have you ever wanted to gain the perspective of 3 different generations on their thoughts on real estate, buying a house, and the whole lending process, mortgage process? Well, here we are. We have
Victoria Suthers, Keller Williams Success Realty.
And your generation?
Generation Z. No,
X.
Generation X. This is X. Generation X.
Yeah, and then Nathan Hess, also with Keller Williams Success Realty, Generation Z.
Okay, and I'm Jerry DuPaw with Rate, and I'm a Millennial. So we were here to just kind of go over questions that maybe the different generations have, hang-ups maybe. I think, Nathan, your generation has a little bit of a hang-up of renting more than wanting to buy.
100%.
Okay, so I think a lot of that has to do with back when there was a problem in 2008 where people saw their parents, go through some tough times with housing. It was a blip on real estate. Real estate always increases in value, if you look over time.
4% a year.
At least.
Average.
And that was a blip having to do with bad mortgages that got corrected, and it totally got corrected, believe me. We make sure you can afford your payment when you get a mortgage, and we make sure it's going to work out better for you financially, and usually it does, but it usually is better than renting.
Well, I've been working with a lot of renters, and one of the main things that comes up is should they rent or should they buy? I've talked to one person so far who they want to sell their house and invest it into that money into something. And I recommended, a house. So could you maybe explain why buying a house is a good investment right now in this day and age?
Sure. Well, basically, it's all about the appreciation. You're putting your investment in a different vehicle. You're putting it basically in the walls of a house. When you pay your rent each month, you're paying down that landlord's money, so he's gaining each month, right? Mm-hmm. So you might as well, if you can afford it, and if it's the same amount as rent and you're able to qualify for a mortgage, there's really no way, at least to check. It's just as people in the past were scared of getting their credit pulled and all this stuff comes to credit scores. That's all with us has gone away. It's just a soft credit pull up front, and there's no cost to figure out the options. So at least figure out the option first before you just jumped into going to rent something.
Sure. Now, does a soft credit pull hurt your credit at all?
Not at all. It doesn't even show up as a credit inquiry. No one would even know it happened. So there's no effect to your score or anything.
I'm currently working with a couple of renters, and I was looking at some of the rental homes that they showed me that they want to see. And I was amazed at how long that landlord has owned those homes. And all I thought to myself is, these tenants over these last 10 to 12 years that this landlord has been renting this home have paid his mortgage. Yeah,
I'm doing a loan right now for a fellow in Florida. He owns 10 investment properties. They're all 2 to 4 unit properties. And he's like a little angel because every one of the units are rented out for $700 a month when really they should be rented out for $1,500, $2,000 a month. So, and literally they're all that way. Luckily, we have a program called DSCR that makes it real simple for him because.
What is DSCR?
Yeah, when you're an investor, as long as the rent payment is going to be higher than what the mortgage payment's going to be, that's all we need to see. We don't need to go through all the other paperwork. He has 10 investment properties. So if he had to go through all the paperwork, it'd be pretty intensive for him. And he's 82 years old, so he's not too techie and stuff. But he needs money for roofs on almost all these houses. They're all getting older. And so we're taking cash out of one of the 4 units with a DSCR loan. And really all we have to do is an appraisal. And that's it. And you can get the money out to do his roofs.
What's the acronym for DSCR for?
Debt service coverage ratio. So it's the ratio between what the rent's going to be compared to what the mortgage payment is. We're able to do it even if it's if the payment's a little bit higher than the rent, not dramatically, 20% higher, we could still do it. But usually you want to try to get the best rate in terms. You want the rent to be $1 more than what the payment's going to be. And then we don't need to show any other documentation. It's great. It's really, really a neat
A good program for investors.
Oh, it's perfect, yeah. What I was thinking about was, you were talking about renting, and when you rent, say you rent a $300,000 house, how much money out of pocket are you going to need right away?
To rent it?
Yeah, to sign the lease and then get in the house.
Usually typically first month's rent, security deposit, which is equal to 1 month's rent.
So say it's a $300,000 house, say it's $2,000 a month rent,
No,
right?
more than that. A $300,000 house. Oh, yeah.
It's just simple numbers.
Simple numbers.
So it's going to be more than that if it's $300,000, but let's just say it's $2,000. Okay. Right? So you're saying first month rent, that's $2,000.
First month's rent, $2,000.
Right away. And then another $2,000 on top of it. What if you have a dog?
If you have a dog, usually it depends on the landlord. They typically ask for upfront pet rent.
What if you have an exotic animal?
That's a good question. Like a parrot?
Yeah. There's some people out there that like these different type of pets, and the landlord's going to be like, no frickin' way.
Yeah.
Well, I mean, at the end of the day, if the landlord chooses to allow a tenant with pets, then he's going to set his staple. And typically I see anywhere from $300 to $1,000. And sometimes I see it that it's refundable or not refundable.
Okay.
So those are what my experience has been when I've shown rentals.
So we're talking about first month rent and then the security deposit and then a pet. So basically like $5,000.
Could be. Yeah. Right? Easily.
Okay. So I don't understand why people would rent as long as they have a 640 credit score. IHDA has a program where you only need to invest 1% of the purchase price into the transaction. And they're going to give you everything else basically because they're going to give you up to $15,000 towards the whole transaction, down payment, closing costs, everything. It's incredible. So on a $300,000 house, that's only $3,000 compared to $5,000 to rent it. And then the $300,000 house payment's going to be at least the same, if not less, than what the rent would be, because it's probably going to be more than $2,000 a month, like Victoria said.
Now, do you have to pay that money back?
It's deferred assistance. So basically, there's no payment, there's no interest rate. It's 0% interest. You have to decide what you want to do when you go to sell a house. You basically have to pay it off at that point.
Okay.
So it's called like a silent second. So at some point, yes, you'll have to pay that off, but you'll gain that equity probably on a $300,000 house within 2.5 years, 2 years, maybe even less. That equity is going to be gained just by living there. And then you're paying your mortgage payment, which is paying down your mortgage each month. So you're gaining equity each month you pay your payment, rather than each month you pay your rent. What are you doing? You're just giving it to someone else to gain equity.
So Jerry, I heard you use the term IHDA.
Yes,
Can you
IHDA.
tell us what that stands for?
Yes, so IHDA is our Illinois Housing Authority here in the state of Illinois, and it helps with all kinds of different down payment assistance programs. I'm just talking about one of them. The one I'm talking about is for first-time home buyers. So each borrower on the loan has to be a first-time home buyer, but IHDA definitely has programs for people that are not first-time home buyers, and up to $10,000 instead of $15,000, so just a little bit less. And they also have programs for people that own a house currently. They can actually buy another house with IHDA funds still. Like they could still get down payment assistance even if they own another house. I think that's pretty incredible. They can rent out the house that they're in and still get down payment assistance for the next house.
But that's building generational wealth.
That is absolutely building generational wealth. And then there's other down payment assistance programs because IHDA limits you to a 640 credit score cutoff. You have to get your score to that level. I can help you get to the score to that level if you're not there. But we do have options for other down payment assistance programs that go down to a 600 credit score. And those options actually don't have that 1% requirement. Like you can literally get into a house with $0. You can get back everything you put up front.
So slow that down a minute. Nathan's working with a friend and they're wanting to buy their first house. And Nathan says to them, you can get into this house for 0%.
Yeah, $0.
Zero down, zero money.
So how does that work?
Really? I mean, like this is a myth. Isn't there a myth out there that
you got to work with a mortgage architect like me.
Mortgage architect. I like that. I get the question, how much do we need to put down? Oh, I don't have 20% to put down. I don't have 10% to put down. 3% is that the minimum to put down?
Yeah, no.
So many of those questions.
It's not.
Let's delve into that a little bit.
And I do this all the time for people because it's obviously when they hear the option, they're like, yeah, we'll take that option. It's just so much more affordable. So we have multiple programs here at Rate that go down all the way to a 600 credit score, like I said, that provide up to 5% of the purchase price and down payment assistance. Again, it's repayable. So there's going to be a payment on this one for the second mortgage, but it makes it so, like when you buy a house, there's some upfront things. What do you have to pay up front, Victoria?
What I have to tell my buyers is that they should have at least $2,000 liquid cash. First $1,000 is for your earnest money, and that can range from $1,000 to $5,000. The second $1,000 would encompass both home inspection, which is going to be the first out-of-pocket expense, and then your appraisal, which is the second out-of-pocket expense. But Jerry tells us that they'll get all this back. That's just great to hear.
There is a way to structure it so you actually get everything that you paid up front back on the day of closing, or most of it.
How do they get the money back?
Yeah. So you're going to pay your $1,000 for your earnest money, and then you're going to pay the home inspector the $500, and then your appraisal is going to be $500. So you have $2,000 up front. In our past example, the renter needed $3,000.
$5,000.
I'm sorry.
Yeah, $5,000.
We can say pets. $5,000 up front. So you're going to go through the mortgage process. As long as you have the offer structured correctly up front, we can set it up so anything you invested up front, you get back on the day of closing. It's a massive swing between buying a house and renting as far as what you need in funds. So that's why I just don't understand, as a millennial doing mortgages, why would anyone rent if we have this fantastic way of being able to own a house? Why? Did they just not know?
I guess so.
Okay.
They don't know these programs exist.
It's a shame, but it's something that we're trying to change here.
Yeah.
So, right? So we're just trying to get the education out there to people because it should be in such a better position financially.
With your mortgage payment, it stays the same. Your principal interest stays the same. That doesn't adjust.
No.
Now, your tax escrow
Right.
and your insurance escrow is what adjusts that mortgage payment, but your rent can go up every year.
That's why your rent goes up every year.
Yeah.
But it's the amount that your rent goes up is going to be the same as your mortgage payment. So that shouldn't be something that you worry about too much.
A mortgage payment is more stable than a rent payment.
Yes.
Because if the landlord all of a sudden had to replace a furnace
Yeah.
and now they want to recoup that furnace expense, they might raise your rent
Right.
more than you would expect because that needed a new furnace
Right.
or a new roof, etc. A mortgage payment is way more stable of a payment than a rental payment.
And you can always get it down as far as if that did happen, you could call me and we could talk about a refinance. If you do have an experience where your taxes jump up, just give me a call. I'm doing it right now for someone that owns a 2-unit in Chicago. Their taxes went up because I think it was underassessed to begin with. We're going to figure out a way to do a refinance to be able to lower down our payment. The nice thing about refinancing too, I can set it up so you skip some payments because that's just the way it works. As far as if you close at the beginning of a month on a refinance, you're not going to make a payment that month, and you'll skip the month after. So you're almost 2 months no payments when you do a refinance to try to catch up, or if you get in trouble. You can't do any of that renting. You have none of those options. So
And at any time, the landlord could decide that he's going to sell the unit.
I'm having that happen right now too. Yeah,
So,
I am.
What else
So-
are you running up against, Nathan, as a young professional?
The people I've worked with is basically just don't know if they want to rent or buy. They don't know the options out there.
What do you think when you're talking to a friend and you say to that friend, I just got in the real estate business? What would you say to that friend to get them out and talking and interviewing with Jerry or talking to a mortgage professional? What would that look like?
Well, first, I would tell them to know what their buying power is. And how you do that is you talk to a lender, someone like Jerry, because you never know. Like with the $15,000 of down payment assistance, I mean, I didn't know you could do that. I'm sure a lot of people, Generation Z, the new generations coming up, I'm sure they don't know that you can get $15,000 on down payment assistance. Yeah. And the lowest credit score requirement, as you said, was 640.
And then 600 for the other program I was talking about where you can get the money back.
Yeah, I mean, that's almost nothing.
I heard you brought some questions for us on your laptop there. Did you have some stuff?
Yeah, I did. Yeah. I sure did. Let's dig into it. One of the questions I had was for that $15,000 for down payment assistance.
Yeah.
How do you qualify for that $15,000?
Well, that program, you need to be a first-time home buyer. A first-time home buyer just means that you haven't owned a house in the past 3 years. So you might be renting for 3 years, then you're considered a first-time home buyer. You also have to be underneath certain income limits. They're pretty high. They're in the $120,000 range for one person, and then they increase as the household size increases. And then you just have to be approved through a regular Fannie Mae or FHA or VA loan. You can get the assistance.
And then, so explain to me again how that repayment works on the down payment assistance?
Yeah, on that particular program for the $15,000, it's a silent second that never has to be repaid until you sell the house. When you sell the house, you just use the equity to pay it off.
What about the ones that have a second loan on them, that they are paying a second mortgage payment?
Most of them are like 10-year terms. The other ones has no interest rate, so it's zero. It's still 0% financing basically. There's one that goes to $10,000. There's one that goes to $7,500, and there's one that's $6,000. That the $6,000 one actually is forgivable over a certain period of time. So there's just a lot of different options, but it depends on how much assistance you need and what's going to work best for you. That's why I need to help structure that. I mean, that's not your job to figure that out. That's what I do every day. So
yeah, relying on a professional that knows the business backwards and forwards.
Right.
It rather than necessarily ChatGPT, because new programs come out. We all know we're all checking AI nowadays, but AI doesn't get you the house.
Right.
Talking to a mortgage professional who can dig into your history, your debts, your income, your jobs, etc., and form a program to get you the house that you're looking to buy for less than rent.
That's why I started calling myself a mortgage architect, because literally I have to, like an architect, figure out exactly what all fits together and what program fits that person perfect. Because there is so many. There is just so many. But did you have another one for us?
Yeah, I'm sure I do. All right, so can you walk us through a real example? So let's say you have a $300,000 home. How much would the buyer need out of pocket?
Basically, if you're using one of our down payment assistance programs, we could set it up. So upfront, you just need the appraisal fee, which is around $500, the home inspection, another $500, and your earnest money could be anywhere between $1,000 to $5,000, which is just a deposit that you end up getting credited back later.
And that can all be paid back, correct? Like reimbursed?
If we set it up correctly with our program with down payment assistance, yes, you can get the appraisal money back that you paid, you can get the home inspection money back that you paid, and you can get all the earnest money back.
That's huge.
The offer has to be structured correctly, and you have to use the right down payment assistance program, but that is possible. And I do it all the time. I have a couple closes a week where people are getting checks back.
You can see I ran through ChatGPT.
I heard today from, I don't know, it was the head of some big agency, that in 18 months, loan officers will be non-existent. Everything will be AI.
That's not true. If you're a loan officer and you don't use AI, you will become non-existent. If you're a realtor and you're not using AI, you will become non-existent. You have to become
it was the head. It was the head of Microsoft.
Does that worry you?
You know what? I do lean heavily into the AI. I did ever since it started. So I remember a few years ago, we went to Jameson's, a restaurant, and I was kind of showing you what it does, and and it was just really amazing. And you're like,
this Gen X person was not embracing it, but let me tell you how much I'm embracing it now. It truly is making a difference in my business.
Yeah, definitely does help just to make sure, what you're trying to express or say comes across exactly how you want to say it. It helps with that, communication for sure, emails, texts, structuring offers, presenting offers to other sides, having that clearly laid out. So there's no spelling mistake errors that you have to worry about, or grammar errors that I was always worried about because, I'm good at math, not so good at typing emails.
So I've been talking to some clients of the baby boomer generation that wanted to downsize. So what are some options for them?
Yeah, we're seeing a lot more of that, more and more, for sure. Empty nesters, and they want to, downsize to like a ranch or something like that. So it's a very competitive market, first of all. You'll see that there's probably going to be multiple offers on a ranch home because there's two people that kind of like that home. Obviously, the downside.
There's too few built. It's easier for a builder to build up rather than wide. It takes less space.
Right, exactly.
Less construction, less foundation.
Yep. Exactly. So we have some ways to help their offer look a lot stronger, like even if they have to sell a home, to make their offer presented more like cash rather than getting a mortgage. So that helps. And the other thing that I'm doing, multiple of them right now, is called home equity conversion mortgages. So you know what that is?
I do not. Please explain.
It's called a HECM.
HECM.
Yeah. So it's a government mortgage by FHA. It was created by Ronald Reagan. So with a whole bunch of things. But one way you can use it is if you're selling a house and you have a whole bunch of equity, rather than putting all that equity into the next house and buying it for cash and then kind of being poor, you could literally take about half of that equity to put it in the next house as a down payment, and then you can live there for the rest of your life with no payment.
Wow.
Still have to pay their taxes, still have to pay their insurance, and then they keep that chunk of money that they would have put into the house and the walls of the house. Now they have it where they can either invest it, probably make money in the market, or they could use it to live their life with vacations, grandkids, college for kids. There's a whole bunch of things they could do with that. Every loan officer here in my branch, all our parents have it. So it tells you something about it.
That's great to know. Yeah. I mean, for when you're talking to your...
That's huge, yeah.
Yep. And it works for people that want to stay in their house. Sometimes they don't want to leave, but they can't afford the payment anymore. It helps with eliminating the payment that way. You can refinance into one of these mortgages rather than using it to purchase another house. Or someone that has a senior has a house paid off and say they want some money to pay for a kid's college or something like that, or a car or some things. We can set it up like a line of credit where they could just take the money out whenever they want, and they never have to make a payment on it.
This is huge considering the first-time home buyers are almost 40 years of age, right?
Yeah, it's definitely a shame. And I think it's just because they think they can't afford the cost of entry. It's just completely backwards. It's horribly backwards because you need more money to rent. So I don't understand it, but we're going to try to fix it this video.
I'm actually more curious, personally, about the HECM. About 40% of their equity goes into the down payment of the new home?
60% goes in.
Okay.
They get 40% left.
Okay, they get 40% and 60% goes
It
into...
all depends on their age. They could
Yeah.
get more. If they're older, they have to put a lot less in. Because it's based on age.
Yeah.
But the younger you are, the less benefit you get. The older you are, the more. They would have to put 60% down on the next house, and then they could keep the 40% themselves and not have a payment for the rest of their lives.
Wow.
I'm doing many of those right now just this month. A lot of times financial advisors call me with that because the seniors, they go to the financial advisor and they're like, I want money for my granddaughter's car, or I want money for, college. And the financial advisor is like, well, you shouldn't take it out of the market right now. And then they call me and there's another way of doing it. Just take it out of the walls of your house. You're doing it as a line of credit, so you can just use whatever you need at that time. And again, you don't have to make a payment on it. So it makes a lot more sense than taking it out of your retirement. There is a rate tied to it, but normally a financial advisor can make more money in the market than what the rate is. That's why it makes sense to do it. And you're not paying the interest monthly. It's just at the end when you go to pay off the loan, kind of like the silent second for IDA, same kind of concept. Where you pay it off when you sell the house and then when you go to sell the house, you had your funeral, the heirs have to now deal with the house. It's still a regular mortgage, so all that has to be done is that mortgage just has to be paid off in some way, so they could sell the house and pay off the mortgage. So the heirs can refinance and buy the house. And what the neat thing is, when the heirs, if they want to buy the house, FHA will just do an appraisal on the house, and they'll allow the heirs to buy the house at 90% of the value.
Wow.
That's if the senior owes more than what the house is worth.
Yeah.
If they don't owe more than what the house is worth, then they're just going to pay off the loan normally.
Sure.
But if it ends up where more is owed than what's the house is worth, that's a really great feature.
It's good protection.
Yeah, it's amazing. And if they do owe more than what the house is worth, no one's responsible. It's called a non-recourse loan. There's no response. That's why the HUD's involved and the FHA mortgage insurance is involved. In case that would happen, everyone's insured. So no one owes any money. We hope you learned something here today and maybe jog some ideas on maybe how you could buy a house rather than renting, so to gain wealth through real estate. It's really a great investment, and we are all here for you with any questions, no matter who you would relate better with as far as Realtor, your different generations. We're here to help and answer anything that you have question-wise, and there's never effect to your credit score. There's no cost to learn your options, no harm in finding out what your options are, right?
Yes. I mean, what it boils down to is the discovery of how you can buy a home.
We appreciate everyone, and we're going to do more of these for educational purposes to help people learn how they can become a homeowner in this day and age. Thank you, everyone.
Thank you.
Appreciate you coming. Thank you so much.
Thank you.
Thank you.